Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome to another episode of the Australian Retirement Podcast. I'm here with financial advisor and good friend James O'Reilly. James, how are you feeling today?
I'm done. Coincidentally, the title of this podcast, it's obviously the focus is going to be around what do you do? Yeah, I'm just completely done from work, and it's I got to get out.
And you don't have to be 60 and nearing proper retirement age to be done.
I have this feeling most days.
For context, we have young children.
Yeah, actually, as a quick side note, it's my I had this morning. I've got a 7-year-old. It's his birthday today, turned 7, and a 4-year-old, and so we
6 and 3. So we're in the same boat.
Oh, cool. Yeah, we were putting we put a few presents around the house, and we're playing hot or colder this morning, and he found his second gift, little gifts, and we could Lou and I just sort of detected that. All right, Grace, our youngest, she's just finding it a bit confronting that her brother's just walking around the house finding presents everywhere. So how can we manage this? So we said, hey, why don't you facilitate the hot or colder game? You know, the problem is that she's both fiercely independent and terrible at the hot or colder game. So she didn't want any help, but it just ended up being she'd just sort of say hotter and just walk to the present, just keep waddling toward them. We're like, no, Grace, just keep your feet still, don't say anything. So that was an undone moment, but I'm not sure it's for work. I think it was just family and in general.
I mean, there's pretty good context to that too, because today we're going to touch on, what do you need to do to retire early? There's a thing called the FIRE movement, so financial independence, retire early, which I believe you have fairly strong opinions on. Multiple viewpoints on. But more broadly, it's having this discussion about if you want to retire, either it's before retirement age, and that's a question we have to ask as well. How do you define retiring early?
Well, let's start with a normal retirement. I mean, the average age for retirement, 67 for men and 63 for women. So we're talking about average of 65. But it's very common for people to retire below 60. Common to the point where you shouldn't really think of yourself as rare by trying to call it in your 50s. Now, I'd say if you're in your 40s, so that's well and truly early as far as I'm concerned.
Definitely.
And even early 50s, if you're fortunate enough and you've worked hard enough to be in a position where you can do that, then power to you. That early retirement now is your retirement's going to look different to most people's in terms of what you do and how you fund it and how much jealousy people show you.
And I think retirement can seem incredibly boring. Like, at 67 or at 60 and you got to wait all this time, then you get your super. And I think the concept of retirement, I try and flip it. This is a motivational speaker coming out.
I'm ready.
It's this idea that we are, at different times we've been told to follow our passion, but passion we know doesn't pay particularly well. So in my view, retirement is kind of having the financial, I don't want to say freedom,
do it,
but to the financial freedom to pursue and have more flexibility in your life and pursue the things you want to do.
Yeah, life on your own terms, right?
Exactly. Mm-hmm. And that doesn't have to be at 60 or 67. This can be at different periods. And it couldn't simply be, a year off to then find another role. And I think that's a part of where this FIRE movement can get mixed up, that I think a lot of people are actually seeking flexibility. They're not seeking to just stop work.
Yeah, that's exactly right.
They're breaking that relationship between the two.
Mm-hmm.
I think the biggest question everyone's going to have, and probably the most important one when you're retiring early, is how much you're going to need. And are there any very simple calculations we could use to understand how much we need? Because you can't retire early unless you think you're in a position that you can.
Yeah. Well,
sound like a double negative.
We've talked about this with an earlier podcast around the idea of making sure that you've got enough to meet your expenses. And the critical thing there is to actually know what your expenses are. A lot of potential people approaching retirement, a lot of those people don't recognize that more often than not, your expenses will go up, not down. When you retire.
Yeah.
And there's a simple reason for that. If you consider your Monday to Friday, let's assume that you work full time, there's 40 hours a week where you're, let's call it financially occupied.
Unable to spend.
Yeah, that's right.
COVID was the perfect opposite example.
Precisely. Yeah. That did wonderful things for the economy. And so as a flow on, when that time gets freed up, you're now going to hopefully utilize that time whether you're playing golf or going on holidays and those sorts of things, your Monday to Friday 9 a.m. to 5 p.m. will no longer be financially occupied time.
Yeah.
And so if you just try to duplicate your expenses right now and assume that they will be my expenses in retirement, you're probably in for a nasty shock, especially early.
Yeah, so many times we just cross them off.
Yeah, that's right. Consider when you go on a holiday, not necessarily a big international holiday, but you take 2 weeks off over the summer holidays or whatever it would be. Your expenses are higher over that period. Some of it is because you're doing special things, and some of it is because you're just financially available.
And I kind of reversed the question from trying to calculate how much people need. I assume they have some sort of grip on that, which maybe that's a very simple assumption, and kind of convert it the other way, which is, and then there's two ways to calculate this as well. One is to look at the amount of capital you have and the amount of income you can sustainably produce in multiple ways, whether that's the different investments that you put together. We've got a rule of thumb that we've built over time, overly simple, is that you can expect to generate just income of 5 to 6% per annum. That's changed in the last 5 years as we've seen interest rates go up, which means on a portfolio of, say, $1 million, you can expect to generate $50,000 in income every year. Do you have is that in the ballpark? Is it?
We would use the same number.
Yeah, quite similar. And then there's the opposite way, which is the most simple and it's almost, I mean, if you reverse engineer, it's almost the same thing, which is the FIRE number. And that's starting from what income and expenses you need and identifying how many years you're going to need that for. So the simple rule on that one is that you multiply your anticipated annual expenses by 25%. But if you think about that, it's just a 4% drawdown rate by 25 times, sorry. Yeah, by 25. And that tells you the amount of money you need to FIRE, to retire early, essentially, or to have flexibility. I think one of the biggest issues people have is assuming that it's going to be this straight line. As you said, you're actually going to spend more, then you're going to spend less. But then aside from that, that's just lifestyle. Your life will change in different ways. We've seen super laws change. We've seen markets change, families change. There's weddings, there's divorces, there's grandchildren, there's moving, there's downsizing, there's upsizing. I can probably keep going and ranting for quite a while. I think given we're focusing on that early retirement and retiring well before 60 and superannuation is available, I think it'd be great if you could expand on, say, the 2 or 3 other ways that you can hold and manage investments to help provide that income before you're able to access super.
Yeah. If you're retiring, for the purposes of this, when we talk about retiring early, we're certainly talking about doing it before 60, so you don't have access to your superannuation. Well, of course, you need to have the investments or the asset base to be able to fund it.
Yeah.
So you can hold that money personally, of course, or you could hold it jointly with your partner. That's an obvious way to do it. You might consider having a family trust. A family trust is perhaps going to offer more flexibility around, especially from a tax perspective, around what you do. And so that can be quite beneficial. I dare say that if you're looking at retiring before 60, you probably have a pretty reasonable asset base
already. Yep.
Yeah. And what's more, if you're retiring well before 60, it's reasonable to think that quite a bit of that asset base is in your own name. So therefore, certainly considering a family trust is going to be more beneficial for that type of person.
I found the holding investments personally or picking each person's, in either part of a couple or partner's name can actually be more complex than you think. There's a lot of people where they put it in the person who's earning more income now, but they don't really like a property and they haven't really thought about 10 or 15 years from now.
Yes.
And how much life and circumstances can change. I'm becoming more aware of that when I see that as well. Maybe it's worth expanding on the 3 benefits of a family trust from that income perspective.
Well, the first one is around the distributions, because of course you get the benefit of being able to distribute that income to ultimately anyone in your family or in line with
trust.
The trust deed. So that's obviously your partner, your children, mother, father, brothers, sisters, uncles, aunties, nieces, nephews. So there's a pretty broad range there for most family trusts. Now there are a couple of caveats in terms of when you do distribute it, what the implications are. So it's not always just a case of just freely flinging everyone money and keeping it in your own pocket. That's fraught with danger. But it certainly does offer more flexibility.
You do have to distribute it to those people.
That's right. So that's the first one. Now, the second one that stands out to me is actually around asset protection, but I'm not entirely sure if that's your line of questioning.
No, it is definitely along that line. It's probably more 2 main benefits of it.
Yeah.
The
second is that the assets in a family trust, they're not owned by you. They're owned by a family trust, and you might you might have control of the family trust or be a beneficiary of the trust. And so that has a number of benefits in terms of if something were to go wrong in your life and you were to be attacked by creditors, maybe you have a business, for instance, and then the business, something goes horribly wrong in that, and maybe you're personally liable. Having money in a family trust can be very advantageous. Not always. It depends on how it's structured and what's going on in there, but it can certainly create a line of separation in terms of what is mine and what can be touched versus what is not mine and what's immune.
Yeah, I think one of the kind of third benefit is related to that, which is it goes outside of your will, or the control of it passes. But a family trust typically has a 80-year term, so it will go beyond probably 2 generations in most cases, and that would be one of the longer term kind of additional benefits of a trust. But the ability to distribute gains or frank credits or income to whoever is better suited at any given time, and to change that should work change between members of a family, incredibly valuable. And the second one in line, and quite popular as well, is using a company. So like a PTY LTD, for those acronym nerds out there. Can you explain how the company differs from the family trust?
Yeah, it has a lot of the same benefits when we talk about asset protection. So again, there's that sort of line in the sand in terms of what is money in my own name, in my own pocket versus money that's separate. The tax rate, at least from an income perspective, is better off typically if you've got a high income, because you're paying 25 to 30%, and that's quite advantageous inside a company. Whereas if the money's in your own name, especially if you've got high income, you could be paying up to 47%, of course. Companies offer a lot of flexibility too in terms of distributions and where the money goes. With family trusts, as a house rule, when you have income, you must distribute it every year. And that
similar
can be
to a
problematic.
managed fund or ETF. Yeah,
that's right. Whereas with a company, you don't have to distribute. You can retain profits in that company, and that for tax purposes, that can be quite advantagegeous. So really, it's offering a lot of flexibility. There is an obvious disadvantage, though, particularly from a tax perspective. Would you like to go through that?
Yeah, I think you no longer get the benefit of the capital gains tax discount when you're holding assets solely through a company. So if you're holding an asset directly or via a trust, and you've held it for more than 12 months, you get a 50% discount on the capital gain, or the capital gain that you make on that investment. So the big drawback, and I think companies historically, for those who have run businesses or had trusts for an extended period of time, are more of a tax delaying mechanism, not a tax reduction mechanism, because at some point you have to declare or pay a fully franked dividend, which is going to be part of your taxable income. And in these cases, it's almost more valuable to do that when you are in retirement and no longer getting an income anyway, and probably when you don't need it.
Yeah.
I think we've considered the main structures, so perhaps it's worth kind of pivoting towards I'd say, aggressive investment and saving strategies.
If I may, just momentarily, if we're talking about companies, I think it'd be remiss of us also not to consider, for early people looking to retire early, the merit of an investment bond.
Yeah.
Now that's set up very similarly to a company, in the sense that it has assets are set aside, but investment bonds are very unique. We could do a whole podcast on those alone.
I think we will be.
Yeah, okay. The advantage of them, though, and it is a really material advantage, is that if you're holding the assets over 10 years, and everything's been done correctly, then you can pay no capital gains tax when you let these go.
At the end, yep.
So you might be coming in here as someone in your mid-40s thinking, I'm already done, but what do I have to do? What do I have to do? If we had the benefit of a 10-year runway, and we said definitively want to be retired at 55, it'd be remiss of you not to certainly consider the merits of investment bonds and how they might complement your retirement plans.
Yeah, that's a perfect segue. You're talking about a savings mechanism that gives you a tax benefit at the end as one of the ways to actually execute on this retiring early.
Well, you're welcome.
Yeah. I think the first one, and we were talking about this off air, and there was quite strong opinions of it. So before we step into the different mechanisms that you can use to invest more aggressively, I think most of this starts with how do you accumulate the capital to retire early, and that's aggressive saving.
Yes.
And there's many schools of thought on this. We share similar schools of thought. I'm reading a book called Die with Zero, which talks a lot more about the value in life is experiences. And essentially it's saying you want to die with zero. I mean, an advisor, if we knew everything, if we were, complete crystal ball and able to see in the future, we'd make sure you had your last dollar the day you were dying, but that's impossible. But it's this idea of valuing experiences, time with people, time with family over the next investment, the next property, what's the incremental lifestyle benefit of that? And I think maybe that relates to the way you think about aggressive saving as well.
Yeah. And you talked earlier on about FIRE, for example, and we consider that to be I consider that to be the really extreme version of this, which is just relentlessly saving every penny, making as many compromises as you possibly can in your life in order to
make all your coffee at home.
Yeah, to get to that financial independence number as quickly as possible and then retire.
Yeah.
And I think there's I follow quite a few threads on FIRE, and there are some real positives to it. One of the positives to it, I think, is that we do live in this hyper materialist world. And I think when you are aggressively forced to go in the opposite direction and ignore all of that, life does become more about the little things, and that's where the magic is, right? And so there's a tremendous benefit that I believe comes there. What I don't like about the FIRE movement is that, to me, it feels like a fool's choice. It's either a case of you can continue to work for a really long time and live this, financially normal life. It'll take you bloody forever to retire, and you'll spend the next however long in misery. Why not make all these tremendous aggressive compromises right now over the next, let's say, 5 to 10 years or whatever the time frame is, and then your life will be fulfilling and happy and you'll never have to work again. And that you were talking at the very beginning of the podcast about what drives, like what's motivating you to say, I'm done, I don't want to do this anymore. Work can be a wonderful way of, if you're lucky enough to work in an environment that you like, it can be a wonderful way of not only having meaningful connections with people, but having a genuine sense of purpose and engagement. And in the same way that there's plenty of extremist, let's call it extremist capitalism, and the way that we're always pushed to buy shit that we don't need and all of those problems, there is also an extremist element of saying, no, don't spend a cent, save every single bit of it day in, day out. Some of the people who are celebrated on FIRE, I look at their lives and I think, geez, that sounds miserable. Like I would much rather try to find a halfway point there.
A balance between both, enjoying experiences, but not penny pinching every dollar.
Yeah, spot on.
And I think it changed. Like, it'd be good to see the experience of when people retire and how life changes. I'm sure a lot of them go back and find work in different passions or in other areas. So it's not flat out, I'm just stopping, because I think that'd be more stressful than working sometimes. But it's probably, so we've talked about how to save more, how to aggressively save. And now it becomes, what are some of the, say, 3 or 4, we'll go through these together. What are some of the more aggressive ways? And these are not recommendations. These are just examples of how people can more aggressively save money or aggressively invest to have the capital working harder so they can retire early.
Well, the real focus here is around saving, as you said. If you're lucky enough that your income is so high that you can have financially poor behaviors and still save good money, then power to you. But yeah, for the vast majority of us, the way toward moving to retiring early is starting to show some grit around your finances. So how can we live at a lower cost? How can we, how can we, what are the things that we say they're the non-negotiables because they truly do give me purpose and I truly do love that and it's worth my money, versus the huge amount of capital that goes toward things that, look, it might give you that little bump, but it's really not going to change the quality of your life at all, this particular item or this particular thing.
Yeah, I think that's always a good starting point, is understanding how much you actually need. And so many people, like as I said, I assume people know that they have control over their spending. Most of them don't, and honestly, they're in two camps. They're either spending more than they should be, or not spending anywhere near enough. And there's this kind of depression era, which I'm sure a lot of listeners relate to, which is the depression era parents have this idea that you should always be accumulating money and never spending it and live incredibly frugally. And I think for us, it's breaking both of those habits at different times, encouraging some people to live the lifestyle that they've worked hard for, and encouraging others to live more within their means. And there's a few in the kind of middle split, I reckon, more. And I'm sure you've probably share similar experiences, that there's more in the barbells than in the middle. I
think you tend to gravitate one way or the other, as a combination of the people that you spend time with and, by extension, the sort of life philosophy that you adopt over time. You're either someone that lives in the moment or is thinking about tomorrow. It's hard to get that balance right.
Yeah, definitely. All right. So I've got 10 years I want to put my capital work as much as I can, and my risk profile is incredibly high.
Yeah.
What's the first thing you'd...
You said that in a really sultry way, mate. My heart started to race a little bit there.
What's the top option that most people would turn to? Not your advice. This is like, what's the top option most people turn to?
In Australia, the number one place people would turn to is property.
Leverage. Yeah. And it's simple. Like compared to what you can borrow to invest in shares, you can borrow, 4 times as much to invest in property?
Yep.
And naturally, leverage just accelerates everything you're doing.
Yeah. Yeah. So
we're wary of this.
Yeah, because leverage, of course, that's the idea of borrowing money to then invest. You're magnifying the gains and you're magnifying losses. It goes both ways. And it surprises a lot of people to learn that if you think about, for example, that age-old shares versus property, shares actually outperform property very consistently over the long term.
Yeah.
But the reason why property performs so wonderfully and has, I'd imagine, probably had a more meaningful impact on the lives of Australians for property investment versus share investment is because when you put $1 into property, normally only 20 cents of it is yours.
Yeah.
And the other 80 cents of it is borrowed. And that has that's done wonderful things for people because they've had, of course, Australian property's done wonderfully over 30 plus years. And people have been hugely magnified into those gains.
6-7 property, literally, if in the last 30 years you bought a property, leverage into the next one, leverage into that, you've done exceptionally well.
Yeah.
That is starting to change, and that's probably not a topic for this podcast, but with higher interest rates, these leveraging strategies become more expensive and more reliant on those capital gains. So
to add to that, we're also, from a lending perspective, a decade ago, we had those inverted commas golden years where you could
thanks.
You're welcome. Where you could purchase a property and then very easily, as soon as you had enough equity, you could just buy another property. You could just wash, rinse, repeat. And when properties were growing in value, that's how you've had some people traditionally that had fairly low incomes, but for investment properties.
Yeah,
that's not possible anymore. Where particularly post Royal Commission, we're so in banking to confirm, we're so dialed into what we call serviceability. Does your income enable you to afford this? And a lot of the time the answer is no. So property investment is amazing, but also similarly, you need a reasonable income and you also need good savings habits because otherwise you're not going to get the loan.
And I think there's a slightly lower risk version of this, also sitting with property. So I'm an investor. I'm looking to retire in the next 10 years. I've paid off most of my mortgage and now I've got a lot of equity. And the next natural evolution would be debt recycling. So again, you're using leverage, but in most cases, people are debt recycling the way we talk about it to invest into a share portfolio. Is that something you talk a lot about? Is it an attractive option for, you probably work with more people from 40 to 60, that earlier retirement than I do?
Yeah, it's a huge one. It's hugely beneficial for a couple of different reasons. The first reason is because similarly, you're still leveraging. You're borrowing money and then you're investing that money. And the technical word here is what we call arbitrage, the idea that the cost of whatever you're doing is exceeded by the benefit of what you're getting. And if that's happening consistently, well, then you can just let that hum and you'll be making money. And so if we're looking at long-term share portfolio investments or returns of 10+% and the cost is 6%, and especially if it's tax deductible to you, the cost is now hopefully 3.5 or 4. Well, now you've got a big gap and that's really driving your wealth. But the other significant benefit, which is embedded into this term debt recycling, is the idea of switching this debt around. And so the way that happens is that you might have a home loan, for example. Hopefully you're getting on top of your home loan and you're making good progress because you've got really good cash flow. And so when you borrow money against that home loan, if the purpose of that loan is for investment, then that loan is likely to be tax deductible to you.
Yep.
Now then, for example, if we're getting income from that investment, so we put that money into a share portfolio and that's paying dividends, for example, we then use those dividends to keep paying off the non-deductible debt.
Yep.
And all the while, what's happening is we're actually converting our debt profile from 100% non-deductible to more and more deductibility over time. We pay off the debt and the non-deductible, and that enables us to borrow more deductible debt. And we're doing this wash, rinse, repeat thing that both improves our tax and also gives you the leverage benefit.
Yeah, I think the key there is, and it requires one, that diversification is important, but it requires a long-term view. It's happening over a period of time. Yeah. This is something you don't want to do too close to your traditional retirement when you're going to no longer be having a salary, but more in that middle stage where you're looking for aggressive wealth accumulation. I mean, one that's close, not, I can't really say close to my heart, but one is, using leverage in share markets. Obviously, share markets are open every day. Your property isn't valued every day. So everyone in the industry knows about a thing called the Colonial First Aid Gear Share Fund. It's probably been used at some point or another.
I can't tell you how much money that fund made me post GFC.
Yeah, I think so many people went into this. So basically, I think it's 2.5 times leveraged of the ASX 200. So you can imagine, if the ASX does 10%, it does 25. If it does -10, it does -25.
Mm-hmm.
And that's one of the few ways that you can leverage. And we won't go along too deep in the rabbit hole of leveraging investments in share markets. And there's a few of those around, but they are the key for these is, yes, leverage on property sees more volatility, and the more you're accelerating your up and your downside. The difference with share markets is you see this every day.
Yeah,
it's only suited to very specific people. Yep. I'd have to suggest.
I love these. You're absolutely right from a risk perspective that management of this is really important. Not just managing the portfolio and observe, but also just psychologically managing yourself when you go through these huge market downturns.
Because even I think the market's fallen more than 10%. I think it's something like 15 times in the last 20 years.
Well,
that means it'd fallen 20 if you're in this.
I have, I've always had my super for as long as I can remember. I've had it in geared investments, because it suits my risk profile.
You can put geared investments into super.
You can, and that's always been a mandate. I'm not going into a super fund unless they have a good range of geared options. And I can speak to the COVID-19 crash. Was that like 9 weeks? It was so fast. It was that just things went so bad so quickly. And over, let's say, sub 12 weeks, sub 3 months, I lost 44% of my entire super balance.
And then it doubled.
Yeah. And the key thing about that too, as we've spoken before in this podcast, is when you lose 44% and it's still on the way down at that moment, you don't know how deep this well is going. It's not a case that, that's the worst of it, 44%. Like, nope, it could be down another 8.
People who weren't leveraged wanted to sell.
That's right, yeah. And so, for mine, I was able to adopt the mindset of like, okay, well, I'm going to invest more money at this price point, and I'm just going to keep being I'm just going to take a really long-term view. But if you're that person who's looking to retire early, really driven to do it, and perhaps you're in your let's say your 40s, I think as you get to your 50s, especially if you're looking to retire early and you're in your 50s, you're probably only 5 or less than 5 years away from actual retirement. Being in geared investments as you get that close, even for an early retirement, is a brave play. It would depend on your assets. Seek advice. But yeah, for some of those people who are really passionate about doing it really early and lucky enough to have the runway to make some good plays here, it'd be remiss of you not to at least evaluate how this might suit you.
Yeah, definitely. And I think one of the simplest and lowest risk by comparison ways is simply just taking a more aggressive growth approach to investing.
Yeah.
So there's 2 types of assets: defensive term deposits, bonds; growth being shares, infrastructure, and very aggressive on the other end as well. So it's more like for those with a more not conservative, but a more balanced risk profile, and those not comfortable with leverage. That's where it kind of sits at the other end, where you're pivoting, you're putting more of your portfolio into those assets that have returned strongly over kind of recent history. I think maybe if there's one kind of takeaway you can give us before we wrap up this episode, it could be around the structure. I think you've already got one. Around how to structure when you get to retirement or in the lead up to retirement. I think we've had a few kind of sharp opinions in this one, which is always good.
Yeah, I'm not going to go near the actual the structure or the quant stuff. I'm going to focus more on the qualitative stuff, which is around having an understanding as to why you're done. Like why are you feeling that way?
I forgot that's what we were talking about.
Because there's a lot of options available for most people. We're really lucky in the sense that there's hopefully you've got a lot of employment options available. People always underestimate what they could do over a long period of time. If you wanted over 3 or 5 years to completely change the career that you're in and the trajectory that you have, we're lucky enough to be able to do that in most cases. So getting to the heart of what's making you feel unhappy in your work, and what's the smallest thing you can do to fix that problem. Now, maybe the answer is the smallest thing I can do to properly fix it is retire. Okay, well then let's lean into that. But spending years and years and years thinking I just absolutely hate this and I want to get out.
That's not great. I think for me, it's all about moderation. So this is in terms of on your saving side, don't go too aggressive in saving and give up on, opportunities, time with family, time with friends. And on the investment side, don't go overly aggressive and leveraged. It's more about, I think you can balance both.
Mm-hmm.
And I think that's for the vast majority of people, I think that's going to end up in the best outcomes. Mm-hmm. But thanks for joining me again, James.
Good fun, mate.
Yeah, I think it was a fun episode.
We said we were going to close this one better.
How are you
feeling about it?
Feeling much better closing this one off. And as usual, we're going to start running some episodes with Q&A from the community, from the audience. Yeah, I think if you go through your podcast player, you can send questions directly through to us. And we're going to bring some case studies and maybe some deep dives into strategy opportunities. So thanks for listening.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.